The president stood at the podium, promising change. Healthcare for everyone, infrastructure rebuilt, a new economy for working families. The crowd roared. The votes were counted. Democracy had spoken. Then he met the bond market. Not in a room. Not in a negotiation. He simply woke up one morning to find the interest rate on government debt had spiked 3 points overnight. No warning. No explanation. Just a number that meant his entire agenda was dead on arrival. Because here's what they don't teach you in civics class. Elections change governments, but bond markets choose what those governments can actually do. You think you live in a democracy. You vote, your candidate wins. Policies are debated, laws are passed. But there's another election happening simultaneously, one you never see, one you can't vote in, and it has veto power over everything your elected officials promise. It's called the bond market. And it's the most powerful force in modern government. More powerful than presidents, more powerful than parliaments, more powerful than the will of the people. Because governments don't run on votes, they run on borrowed money, and the people who lend that money don't care about your mandate. This is the story of the invisible electorate, the market that selects which campaign promises live and which ones die. The silent auction where your country's future is sold to the highest bidder every single day. And it starts with a simple question nobody wants you to ask. If your government can print money, why does it borrow it? Washington, D.C., 1993. Bill Clinton has just been elected president on a wave of populist fury. For 12 years, Republicans held the White House. The economy has stagnated. The middle class is hurting. Clinton ran on a promise: massive public investment, infrastructure, education, healthcare reform, a Marshall Plan for America's cities. His economic team gathers for the first briefing. The numbers come back, and Clinton's face goes pale. "You mean to tell me," he says, "that the success of my program and my re-election hinges on the Federal Reserve and a bunch of fucking bond traders?" His advisor, James Carville, would later say it more bluntly. "I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a 400 baseball hitter. But now I would like to come back as the bond market." You can intimidate everybody. What happened? Simple. When Clinton announced his spending plans, bond traders looked at the projected deficits and decided the government would need to borrow more. More borrowing means more bond supply. More supply means lower bond prices. Lower prices mean higher interest rates. Within weeks, the rate on 10-year Treasury bonds jumped from 5.2% to 6.2%. That single percentage point meant billions more in annual interest payments. It meant Clinton's entire domestic agenda would blow up the deficit even further. It meant political suicide. Clinton had a choice: fight the bond market and watch the economy collapse under rising rates, or abandon his campaign promises and embrace austerity. He caved. The infrastructure plan died. Healthcare reform was gutted. The progressive agenda that won him the presidency was sacrificed at the altar of bond market confidence. The bond traders hadn't voted against Clinton. They just made it financially impossible for him to govern the way he promised. And he wasn't the first. He wouldn't be the last. What exactly is the bond market? And how did a bunch of traders get more power than elected governments? Think of it like this. When a government needs money beyond what it collects in taxes, it doesn't just print it. It borrows it. It issues bonds, essentially IOUs, that promise to pay back the money with interest over time. Those bonds are sold at auction. Investors, banks, pension funds, foreign governments, they all bid on these bonds. The interest rate the government pays is determined by how much demand there is. High demand, low interest rates. The government borrows cheap. Low demand, high interest rates. The government pays more to borrow, which means less money for everything else. Now here's the key. Bond markets react instantly to government policy. Announce a big spending program, bond traders assume higher deficits, start selling bonds, rates spike, announce austerity cuts, traders assume lower deficits, buy bonds, rates drop. It's not a conspiracy. It's a mechanism. A market that continuously prices the risk of lending to governments. But the effect is the same as if there were a shadow parliament with veto power over every budget. And unlike voters, bond markets can't be lied to. Campaign promises don't move them. Rhetoric doesn't sway them. They only care about one thing. Will they get paid back? And what's the risk? A government can tell its people whatever it wants, but it has to tell the bond market the truth, because the bond market has something voters don't. The ability to make governing impossible by refusing to lend, or by demanding interest rates so high that debt service consumes the entire budget. It's democracy with a leash, and the bond market holds it. 1976. The British economy is collapsing. Inflation is raging at 25%. Unemployment is soaring. The pound is in freefall. The Labour government, led by Prime Minister James Callaghan, has run out of money. They need a loan. Not from a bank. from the International Monetary Fund. But the IMF doesn't lend out of charity. It lends with conditions, and those conditions are dictated by one thing: what will restore confidence in British government bonds? The answer? Austerity. Slash public spending. Cut social programs. Reduce the deficit. Make Britain safe for bond investors again. Callaghan goes on television and delivers the eulogy for post-war social democracy. We used to think that you could spend your way out of a recession. I tell you in all candor that that option no longer exists. Why not? Because the bond market said so. British voters had elected a Labour government to protect the welfare state, but the bond market demanded its dismantling as the price of continued lending. And without that lending, the government couldn't function. The voters wanted one thing, the bond market demanded another. The bond market won. This wasn't a coup. There were no tanks in the streets, just a quiet financial mechanism that made the democratic choice unaffordable. A decade later, the same scene would play out across Latin America. Mexico, Argentina, Brazil, all of them hit by debt crises in the 1,980 seconds. All of them forced to accept IMF conditions. Privatize state assets, cut spending, open markets to foreign capital. Not because their people voted for it, because the bond market demanded it as the price of refinancing their debt. By the 1,990 seconds, it had a name: the Washington Consensus. A set of policies that countries had to adopt if they wanted access to international credit. Free markets, fiscal discipline, deregulation. It didn't matter what voters wanted. If you wanted to borrow, you followed the rules, and the rules were written by the people who bought the bonds. It gets really insidious. Governments don't just borrow when they're in crisis. They borrow constantly. Because modern states run on deficit spending, they spend more than they collect in taxes every single year. The United States hasn't had a balanced budget since 2001. Japan hasn't had one since 1992. Most European countries run permanent deficits. This means governments are constantly issuing new bonds to roll over old debt. Every month, every week, they're going back to the bond market asking for more money. And every time they do, the bond market gets to vote on their policies. Propose a wealth tax? Bond yields spike because traders worry the rich will move their money. Propose a Green New Deal? Bond yields spike because traders see massive deficits ahead. Propose universal health care? Bond yields spike because traders doubt the fiscal sustainability. The bond market doesn't have to organize. It doesn't have to lobby. It doesn't have to bribe. It just has to stop buying bonds or demand higher interest rates. And suddenly, the policy is unaffordable. It's the perfect veto: silent, automatic, unaccountable. Because bond traders don't answer to voters. They answer to their own balance sheets. And if a government policy threatens their returns, they sell. That's not corruption. That's just markets working. But the result is that democratic governments can only pursue policies that bond markets approve. Everything else is off the table. Not because it's illegal, not because voters oppose it, but because it's financially impossible. You can vote for change all you want, but if the bond market says no, the answer is no. 2010. The Eurozone debt crisis is erupting. Greece's government has been cooking its books for years, hiding the true size of its deficit. When the truth comes out, bond markets panic. The interest rate on Greek government bonds explodes from 4% to 12% to 25% to 40%. At 40%, it's not borrowing. It's a death sentence. No government can pay 40% interest on its debt and survive. Greece is locked out of the bond market entirely. It can't borrow. It can't pay its bills. The government is about to collapse. Enter the European Union and the IMF with a bailout. But the bailout comes with conditions, brutal conditions. Cut pensions by 40%, slash public sector wages, fire a quarter of government employees, sell off ports, airports, utilities, national assets, privatized and sold to foreign investors at fire sale prices. The Greek people riot in the streets. They didn't vote for this. They didn't choose austerity. But their government has no choice, because the bond market cut them off, and the only way back to solvency is to do whatever makes bond markets feel safe again. Here's the thing that should terrify you. Greece had a democratically elected government. That government opposed austerity. The people opposed austerity. But they were overruled, not by a foreign army, not by a dictator, by bond market mechanics. The Troika, the EU, ECB, and IMF didn't invade Greece. They just said, if you want money to keep your government running, you'll do what we say. And what they said was dictated by what would make Greek bonds attractive to investors again. In 2015, Greece elected a radical left government explicitly on a platform of rejecting austerity. Alexis Tsipras and his Syriza party won in a landslide. The people had spoken. Tsipras tried to negotiate. He held a referendum. 61% of Greeks voted to reject the bailout conditions. 2 weeks later, Tsipras capitulated. He signed a deal accepting even harsher austerity than before. Why? Because the European Central Bank threatened to cut off emergency lending to Greek banks. Without that lending, the banks would collapse. ATMs would go dark. The economy would implode. Tsipras could have the democratic mandate of his people, or he could have a functioning economy. Not both. He chose survival. And the bond market's terms were the price. Democracy had voted. The bond market vetoed. Who actually controls the bond market? It's not a shadowy conspiracy. It's not a secret cabal in a smoke-filled room. It's a decentralized network of investors making individual decisions that collectively steer government policy. Pension funds in California, sovereign wealth funds in Norway, insurance companies in Tokyo, central banks in Beijing, hedge funds in London. They're all buying and selling government bonds constantly, based on their assessment of risk and return. But here's what makes it so powerful. They don't need to coordinate. They don't need to agree. Market forces do the coordination for them. If a government announces a policy that looks fiscally reckless, thousands of bond traders independently come to the same conclusion. Sell. The selling pushes yields higher. Higher yields force the government to reconsider. It's a distributed veto system. No one person controls it, but the collective effect is total. And the biggest players in this market aren't even trying to influence policy. They're just trying to protect their returns. But protection and political power are the same thing when you're the lender. Here's the scale. The global bond market is worth over $130 trillion. That's more than global GDP, more than all stock markets combined. It's the largest financial market on Earth. The United States alone has $26 trillion in outstanding government debt. Japan has $9 trillion. China has $7 trillion. Every day, trillions of dollars in bonds are traded. Every trade is a vote on government policy. And the aggregate result of those votes determines what governments can afford to do. The people who manage this money, fund managers at BlackRock, PIMCO, Vanguard, they control more capital than most countries' entire economies. Larry Fink, CEO of BlackRock, manages $10 trillion in assets. That's more than the GDP of every country except the U.S. and China. When he speaks, finance ministers listen. Not because he threatens them, but because if BlackRock decides a country's bonds are too risky, that country's borrowing costs skyrocket. It's power without authority, influence without accountability, and it shapes government policy more than any election. 2011. Silvio Berlusconi is prime minister. He's scandal-plagued, corrupt, but democratically elected. Then the bond market moves. Italian bond yields spike above 7%, the level that had forced Greece, Ireland, and Portugal into bailouts. Berlusconi's government hasn't collapsed. He still has parliamentary support. But the bond market has lost confidence. Within days, Berlusconi resigns. Not because of a vote of no confidence, not because of criminal charges, because the bond market made it clear. He had to go, or Italy would be locked out of credit markets. His replacement? Mario Monti, a technocrat, an economist, never elected to anything, appointed by the president to restore market confidence. Monti immediately implements austerity, tax increases, pension cuts, labor market reforms, everything the bond market wanted. Italian voters didn't choose this. They didn't vote for Monti. They didn't vote for austerity. But the bond market did. And in the end, that's the only vote that mattered. The same thing happened in Greece. Lucas Papademos, an unelected technocrat, was installed as prime minister to implement bailout terms. 2 democracies, 2 elected leaders removed, 2 technocrats installed, all in the name of market confidence. This is the quiet coup. No violence, no military, just bond yields rising until the government has no choice but to comply. And the terrifying part? It's legal. It's normal. It's just how modern government finance works. The darkest part of all. Governments have become addicted to this system. Because bond markets don't just constrain governments, they enable them. Think about it. Without the ability to borrow, governments would have to live within their tax revenue. Every spending promise would require an immediate tax increase. Every war would need to be paid for up front. Every social program would require cutting something else. Politicians hate that. Voters hate that. So they borrow instead. Borrowing lets you promise everything and pay for nothing. Now, you push the bill into the future. And as long as the bond market keeps lending, the game continues. This is why governments defend the bond market even when it constrains them, because it also empowers them. It lets them avoid hard choices. It lets them spend beyond their means. It lets them stay popular without fiscal discipline. The bond market is both the master and the enabler. Governments are trapped in a codependency. They resent the control, but they need the money. And bond markets know this. They know governments can't survive without them, so they can demand anything: austerity, privatization, deregulation, whatever makes lending safer, more profitable. It's not extortion. It's just the terms of the deal. Governments need money. Bond markets have money. The bond markets set the price. And the price is sovereignty. What does this mean for you? It means that when you vote, you're choosing between options that have already been pre-approved by the bond market. Want universal health care? The bond market will decide if your country can afford it. Want a Green New Deal? The bond market will price the risk and determine the interest rate. Want to tax the wealthy? The bond market will assess capital flight risk and adjust accordingly. You can elect the most progressive, the most radical, the most transformative leader you can imagine. But if the bond market says no, that leader will either cave like Clinton, capitulate like Tsipras, or be removed like Berlusconi. Your vote matters. But the bond market's vote matters more. And here's the really insidious part. You can't even blame anyone. There's no villain, no conspiracy. Just market forces doing what market forces do, pricing risk, seeking returns, protecting capital. The system is invisible because it's automatic. And it's automatic because it's profitable. Every bond trader is just doing their job. Every fund manager is just fulfilling their fiduciary duty. Every central bank is just managing risk. But the collective effect is a system where democracy functions only within boundaries set by creditors. It's not tyranny. It's not even corruption. It's just math. Governments that defy bond markets pay higher interest rates. Higher rates mean larger deficits. Larger deficits scare bond markets more. A doom loop. So governments learn to stay within the lines. They learn to speak the language of fiscal credibility. They learn that campaign promises are negotiable, but debt service is not. And slowly, quietly, without anyone noticing, democracy becomes a performance. The real decisions are made in bond auctions. August 2011. The United States does something unprecedented. A credit rating agency downgrades U.S. government debt. For the first time in history, American Treasury bonds are no longer rated AAA. Standard & Poor's drops them to AA+. The reason? Political dysfunction. Congress had just nearly refused to raise the debt ceiling, almost forcing the U.S. government to default on its obligations for the first time ever. The downgrade was a warning shot. Even the United States, the most powerful country on earth with the world's reserve currency, is not immune to bond market discipline. If America can't get its fiscal house in order, bond markets will punish it, not with tanks, not with sanctions, just by demanding higher interest rates. And here's the thing, it worked. The threat of rising borrowing costs forced politicians to negotiate. The debt ceiling was raised, crisis averted. But the message was clear. Bond markets can discipline even the U.S. government. Now imagine what they can do to smaller countries. Argentina, 2001. The government defaults on $132 billion in debt, the largest sovereign default in history at the time. Bond markets lock Argentina out entirely. For nearly 15 years, Argentina can't borrow internationally, can't finance deficits, can't invest in infrastructure. The economy stagnates. Finally, in 2016, Argentina settles with its creditors, pays them $9.3 billion money desperately needed for schools, hospitals, development to regain access to bond markets. The bond market had held an entire country hostage for 15 years, not because of ideology, just because of default risk. When Argentina finally returned to borrowing, what did it do? Issued $16.5 billion in new bonds. The appetite was enormous. Investors made billions. The cycle began again. Term for this in economics, bond vigilantes. It was coined in the 1,980 seconds to describe bond traders who enforce fiscal discipline on governments by selling bonds and pushing up interest rates when they perceive reckless spending. The term is almost heroic. Vigilantes, keeping governments honest, preventing fiscal irresponsibility. But vigilantes don't answer to the law. They enforce their own justice. And bond vigilantes don't answer to voters. They enforce their own vision of fiscal responsibility, which almost always means austerity, cuts to social spending, and policies that protect creditor interests. They're not elected, they're not accountable, but they have power that elected officials can only dream of. Ed Yardeni, the economist who coined the term, said, "If the fiscal and monetary authorities won't regulate the economy, the bond vigilantes will." Read that again. The bond market sees itself as a regulator, a check on government power, a force for discipline. But who regulates the regulators? Nobody. The bond market regulates governments. But voters don't regulate the bond market. Governments don't regulate the bond market. The bond market regulates itself. And its only goal is return on investment, not justice, not equality, not democracy, just return on investment. Is there any escape? Could governments just stop borrowing, live within their means, free themselves from bond market control? In theory, yes. In practice, no. Because modern states are built on deficit spending. defense budgets, social security, healthcare, infrastructure. All of it costs more than tax revenue covers. To balance the budget would require either massive tax increases or massive spending cuts. Both are political suicide. Every politician who's tried has been voted out. Remember George H.W. Bush? Read my lips, no new taxes. Then he raised taxes to reduce the deficit. He lost re-election. Voters say they want fiscal responsibility. But they vote for whoever promises them more benefits without higher taxes. So politicians borrow, and the bond market enables it, until the debt gets too large. Then the bond market demands austerity, and the cycle repeats. There's another option: print money instead of borrowing it. Governments with their own currency can theoretically create money to pay for spending. No debt, no interest, no bond market control. But there's a catch. It's called inflation. Create too much money, and the currency loses value. Prices spike, savings evaporate, the economy collapses. Weimar Germany tried this in the 1,920 seconds. Zimbabwe tried it in the 2000s. Venezuela tried it in the 2010 seconds. Every time, hyperinflation destroyed the economy. So governments borrow instead. It's slower, safer, but it means surrendering control to the bond market. There's no escape, only trade-offs. Democracy or solvency, sovereignty or stability, freedom or financing. The bond market offers a deal. We'll lend you the money to keep governing, but we decide the terms. And governments take the deal. Every time. Because the alternative is immediate collapse. Japan offers a glimpse of where this ends. Japan's government debt is 264% of GDP, the highest in the developed world. It's been running deficits for 3 decades. By all conventional logic, Japan should have collapsed. Bond markets should have revolted. Interest rates should have exploded. But they didn't. Because Japan found a loophole. The Bank of Japan, the central bank, started buying government bonds itself, trillions of yen worth. It now owns nearly half of all Japanese government debt. This is called monetary financing. The government borrows from its own central bank, no bond market necessary. It's technically not printing money, but it's close. The central bank creates money to buy government bonds. The government spends that money into the economy. And so far, it's worked. Japan hasn't collapsed, inflation has stayed low, the economy functions. But here's the catch: Japan is trapped. It can never stop. If the Bank of Japan stops buying bonds, private markets would have to absorb all that debt, and they wouldn't. At least, not at low interest rates. So the central bank has to keep buying, forever. Japan's debt can never be paid off. It can only be rolled over, with the central bank as the eternal buyer. It's fiscal solvency through monetary illusion. And it only works because everyone agrees to pretend it's sustainable. Other countries are starting to follow. The Federal Reserve bought trillions in bonds during COVID. The European Central Bank does the same. Central banks are slowly replacing bond markets as the lenders to governments. But is that better or worse? With bond markets, at least there's market discipline. Unsustainable policies get punished with higher rates. With central bank financing, there's no discipline. Governments can borrow infinitely until inflation explodes, or the currency collapses, or some other unpredictable crisis hits. We're in uncharted territory, and no one knows how it ends. You need to understand, the bond market isn't a conspiracy. It's a mechanism, a global, decentralized pricing system for government credit risk. But mechanisms have consequences, and the consequence of this one is that democracy operates inside a cage built by creditors. You can vote for whoever you want. But your vote is subject to veto by people who never appear on a ballot. You can demand change, but change costs money, and money costs interest, and interest is determined by bond markets. The politicians you elect know this. They campaign on bold promises. Then they meet the bond traders, and the promises die. Not because of corruption, because of arithmetic. Governments that ignore bond markets pay higher interest rates. Higher rates mean bigger deficits. Bigger deficits scare bond markets more. Rates rise further. Eventually, borrowing becomes impossible. So governments comply. They stay within the invisible boundaries. They pursue policies that reassure creditors. They sacrifice democracy on the altar of fiscal credibility. And we call it responsible governance. The bond market doesn't rule through force. It rules through dependency. Governments need money. Bond markets have money. The price of that money is obedience. Not explicit obedience. Not formal control. Just the quiet understanding that some policies are affordable and others aren't. And affordability is determined not by voters, but by lenders. Clinton learned this. Berlusconi learned this. Tsipras learned this. Every leader learns it eventually. You can have a mandate from the people, or you can have affordable borrowing costs. Choose one. And if you choose the mandate, the The bond market will make governing so expensive that you'll fail anyway, and then voters will blame you for the failure. So leaders choose the bond market. They dress it up as pragmatism, fiscal responsibility, mature governance. But it's surrender, quiet, invisible, complete. The bond market doesn't need to threaten. It doesn't need to lobby. It just needs to exist, and its existence is enough to veto any policy that threatens creditor interests. This is the invisible constitution, written not in law but in interest rates, enforced not by courts but by markets. And it has one rule: creditors come first. Not citizens, not voters, not even elected governments. Creditors, always. What do you do with this knowledge? You could despair, accept that democracy is theater and real power lies elsewhere. Or you could see clearly. Understand that every political debate happens inside boundaries set by bond markets, that every campaign promise is conditional on bond market approval. You could ask the question nobody wants to answer: why do we accept a system where elected governments are subordinate to unelected creditors? Why do we treat bond market demands as natural law instead of political choices? Why do we let fiscal credibility override democratic mandates? These questions don't have easy answers, but they're the right questions, because the bond market's power isn't natural. It's constructed. It's a system we built, and systems can be rebuilt. Countries could finance spending through their central banks instead of bond markets. Risky, but possible. Countries could default on debts and accept temporary exclusion from credit markets. Painful, but survivable. Countries could cooperate to regulate bond markets and limit speculative attacks on sovereign debt. Difficult, but not impossible. There are alternatives, but they require questioning the fundamental assumption that government solvency is more important than government sovereignty. And that's a question bond markets don't want you to ask. The president stood at the podium, promising change. The bond traders sat at their desks, pricing that promise. And by the time the speech was over, they'd already decided which parts would survive and which would die. Not with votes, not with vetoes, just with interest rates. The crowd never knew. The president knew. He'd known since his first briefing. That's how the system works. You campaign for the people, you govern for the bond market, and you hope the voters never notice who's really in charge. History doesn't repeat, it reveals. And right now, it's revealing a simple truth. Elections are real, but they're not sovereign. The bond market is sovereign. Your vote is advisory. Welcome to the democracy you thought you lived in. Now you know who writes the budget? And it's not the people you elected.